Welcome back, everyone. Today, we're diving into a brand new explainer that explores the absolute architectural logic of the business world. I'm talking about the rules of debit and credit. Now, whether you're dissecting some massive corporate balance sheet or just looking at the cash flows of a scrappy startup, these mechanics, they're the universal language of finance. We're going to go way beyond just rote memorization today to uncover exactly why these rules exist and how they act as the ultimate system of checks and balances. So, we're going to break down the two major frameworks. We've got the traditional British approach, which leans heavily on behavioral logic, and the modern American approach, which is pure mathematics. And I'm going to show you how they both expertly lead us to the exact same perfectly balanced destination.
Okay, so here's our roadmap for this explainer. First, we'll cover debit and credit basics. Then we'll look at the traditional approach, dive into the golden rules, check out the modern approach, and finally, we'll wrap up with T-shape accounts. Let's get right into it.
Section 1. Debit and credit basics. So imagine trying to track thousands of daily transactions, from payroll to vendor payments, without absolute chaos breaking out. It's impossible, right? That's why businesses have to centralize their records under specific operational heads, like, say, cash or inventory. And that centralized record is simply what we call an account. Visually, think of this account as taking the shape of a giant capital letter T. The vertical line running down the middle establishes two completely separate halves. Your entire left-hand side is officially designated as your debit side, which we abbreviate as DR. And the entire right-hand side, that's your credit side, abbreviated as CR. It's literally as simple as left and right. Now, inside that T-shape, structurally mirrored on both the debit and credit sides, you've got four vital columns. You always start with the date of the transaction. Next up is the particulars. This basically acts as a brief contextual description, so noting, for example, that a specific influx of cash came directly from sales. Third is the actual financial amount. But honestly, the most crucial column for keeping your accounting integrity intact is the journal folio, or JF. A folio literally just means a page number. See, before any entry ever makes it into this summarized T account, it's first recorded chronologically in a primary journal. So the JF column acts as your ultimate audit trail. It ensures you can always trace a summarized number right back to its root transaction. It makes error checking incredibly efficient. Moving on to Section 2. Traditional approach, 3 accounts. What's really fascinating about the traditional, or British approach, is how it manages to categorize the entire, wildly chaotic business ecosystem into just 3 distinct buckets. The first of these is the real account. This category deals entirely with the long-term wealth and assets of the firm. So it captures your tangible assets, the physical bedrock of the business, stuff you can actually touch like cash, land, buildings, and machinery. But crucially, it also captures your intangible assets. These are highly valuable elements you can't physically touch, like a company's acquired goodwill or its patents and copyrights. Think of the proprietary algorithm of a massive tech giant. If it holds value and it represents something the business actually owns, it is fundamentally a real account. Bucket number 2 is the nominal account. Now, if real accounts represent what you own, nominal accounts represent what you actually do. This category focuses squarely on the day-to-day operational reality of running your business. It captures every single expense and loss that drains your resources, like paying the monthly rent, covering employee salaries, or, say, absorbing a loss from a warehouse fire. On the exact opposite end of that spectrum, it relentlessly tracks your daily incomes and gains, the revenue generated from your primary sales, or maybe an unexpected commission you received. These are essentially temporary accounts, tracking the flow of operations over just a single year. The third and final category is the personal account, which generally deals with external parties and people. But here is a super interesting philosophical question that actually sparks a lot of debate in early accounting studies. Where exactly does capital, the initial money invested by the owner, fit into all of this? Since it belongs to the owner, is capital actually considered a natural person? To really unravel that, we need to look at the 3 subtypes of personal accounts. First, we have natural persons. These are actual, living, breathing human beings created by nature like Rohit or Olivia. Second, we have artificial persons. These are legal entities created by humans and recognized by the court system, like a multinational corporation such as Reliance or an institution like a bank.
Finally, we have representative persons. And right here is how we resolve our big debate. Capital isn't a natural person itself, right? But it accurately represents the human owner's financial footprint within the business. Therefore, it is categorized as a representative personal account, standing right alongside things like outstanding salary, which collectively represents the money currently owed to a group of employees. Makes total sense.
All right, Section 3, the golden rules of accounting. Now that we've got our 3 defining accounts down, we can apply the core mechanic of a traditional approach, the golden rules. You absolutely need to memorize these. There are behavioral rules dictating exactly how value moves. For a real account which captures your assets, the rule is to debit what comes into the business and credit what goes out. Simple. Cash arrives, debit it. Cash leaves, credit it. For a nominal account managing your operations, you debit all your expenses and losses, which effectively recognizes the cost of doing business, and you credit all your incomes and gains to record the upside. Finally, for a personal account dealing with external parties, you debit the receiver of a benefit and you credit the giver. If a supplier gives you machinery on credit, they are the giver, so their specific account gets credited. If you internalize this logic, the traditional framework will literally always keep your books perfectly aligned. Section 4. Modern approach, the new way. But hey, what if you prefer a more objective, purely mathematical logic over behavioral rules? Well, the modern American approach completely abandons the concepts of givers, receivers, and nominals. Instead, it categorizes everything into 5 distinct heads based entirely on their natural numerical balance. To map this system instantly in your mind, you just split these 5 heads into 2 core groups. Group 1 contains your assets and your expenses. In this modern framework, assets and expenses naturally possess a debit balance. Group 2 handles everything else: liabilities, capital, and income. These 3 heads naturally carry a credit balance. Honestly, locking in the fact that assets and expenses live natively on the debit side is the only key you need to unlock the rest of the whole shebang. So the rule here is driven by pure mathematical harmony. To increase an item's value, you just reinforce its natural balance. To shrink it, you do the exact opposite. Because assets and expenses naturally live on the debit side, an increase means applying a debit, while a decrease demands a counteracting credit. Conversely, because liabilities, capital, and income maintain a natural credit balance, increasing them requires you to credit them. To decrease their value, you simply debit them. It's brilliant because it removes all the guesswork about who is receiving or giving. It just replaces it with a straightforward algebraic system. Okay, let's actually put this mathematical logic to the test to see how smoothly it operates in the real world. Imagine you're outfitting a brand new commercial office. You're purchasing large amounts of furniture, and you're paying for it completely in cash. How exactly does the modern approach process this very standard dual-sided transaction? Well, both furniture and cash fall squarely under the category of assets. And under the modern approach, we know assets carry a natural debit balance. So when you acquire that new furniture, your overall furniture asset increases. To reinforce an increase in asset, you debit it. But to acquire it, you had to hand over cash. So your cash asset decreases. To shrink an asset, you do the opposite. You credit it. One debit to boost your furniture, one credit to reduce your cash. The underlying truth of accounting is elegantly maintained here. Every action has an equal and opposite reaction. It keeps your books flawlessly balanced without a single cent unaccounted for. Almost done. Section 5. Creating T-shaped accounts. Let's look at the final, highly practical step of everyday accounting, actually balancing the ledger. It's a really precise 3-step mechanical process. First, you calculate the total for both the left debit side and the right credit side. Let's say over the year you accumulated exactly $65,000 in furniture on the debit side. Second, you find the difference. Because, let's be real, over that same time, you probably sold some pieces off. Or maybe you playfully discarded some broken, obsolete chairs into a bonfire, registering $18,000 out on the credit side. The difference between those two numbers is $47,000. Step 3, you write that $47,000 balance onto the shorter credit side. Now, both sides visually total exactly $65,000 at the bottom. The account is officially closed and balanced for the period, and that $47,000 represents the true, verified value of the furniture you're carrying forward. And just like that, we've reached the end of our deep dive into the foundational mechanics of debit and credit. Whether you lean toward the behavioral elegance of the traditional British approach with its golden rules of receivers and givers, or you prefer the mathematical precision of the modern American approach with its debit and credit balances, the absolute beauty of accounting is that both paths securely lead to the exact same accurate destination. So here's my final question for you. Which structural path are you going to practice and master first? Keep reviewing these fundamental mechanics, and we will see you in the next explainer.